Now for the bigger picture, Eddie Ghabour is with us, owner, Key Advisors. Eddie Ghabour, what are you thinking here? I'm tossing it to you with some green arrows today.
Yeah, look, this market has been range bound here for the last few weeks, obviously, sending some mixed signals. You know, just 2 weeks ago, we were worried about a banking crisis. Now, all of a sudden, everybody thinks everything is fine. At the end of the day, when we continue to focus on the data that comes in each day versus the headlines of the day that are moving markets, and the data, in our opinion, is going to get materially worse over the next few months. And then we're going to look to start buying for our clients in the summer months. But we think we're going to hit new lows by June, and it could get uglier. We expect it to get uglier in the summer. When you take a look at the macro backdrop, right, we have over the next 3 months, we're going to be faced with this debt ceiling debate, which if it's anything like 2011, it's going to cause some panic in the market potentially. And I believe the market dropped 18% in 2011 between April and August time period. And we didn't have this macro event that we're dealing with now. So I think it's going to be clear that we're in a recession. At the same time, we're dealing with this debt ceiling debate. And that's chaos is going to potentially bring a lot of opportunity. But we're still very heavy in cash. But we are very bullish on treasuries right now. That's an area we've been buying and continue to be bullish on.
So with the concerns that you have about the broader market, the way to go here is treasuries. I want to hear how you're bullish on treasuries. Explain what you're telling investors to do.
So what we've been doing for clients, especially the last 2 weeks, we've been very active because the bond market has been pretty volatile, in our opinion, has brought some opportunity. So we've been buying the long end of the curve using ETFs, and it's a play on capital appreciation, not the actual dividend yield. And the reasoning behind that is, traditionally speaking, when you go into a recession, you'll see that long end of the curve really start to come down. And when you look at last year, these long-term government bonds had one of the worst years in history. So we believe we are buying these asset prices at very, very low prices ahead of ahead of a recession. And if we're right in our call, we could get some very handsome returns over the next 3 to 6 months. At that point in time, we would look to take profits from those treasuries and look to start buying equities, because that will kind of coincide with where we think the bottoming process is going to come. But look, that inversion of the 3-month and 10-year yield is over 100 basis points. That is, in our opinion, a pretty clear sign that we are in a recession, and it will be proven to be a recession by the time we get to the summer.
When we expect to see earnings then, so you'll think earnings are going to be coming in too then, right? Particularly for what kinds of companies, or just overall large cap?
Look, any company that has a lot of leverage that's tied to the consumer is in serious trouble, right? Because it's a known fact now that we have a tremendous amount of corporate debt that has to get refinanced. When it gets refinanced, it's not going to be at the current rate. It could be 2 to 3 times higher. So the cost of business is going to go up while demand is going down. So I think you're going to see companies guide down. I think you're going to see some disappointing earnings from an overall perspective. Of course, there'll be some silver linings with some companies that do well, but from a broader market perspective, I think you're going to see earnings continue to decelerate, profits decelerate. And again, that's all coming at the same time we have to deal with this debt ceiling. That is a big deal for the market.
Right, and they don't seem to be dealing with it at this current time. I mean, I watch all these lawmakers on a regular basis, and they just don't seem anywhere close. I mean, it always ends up being all this political posturing, and they always seem to get it done, right? Don't you think in the end they get it done?
They will get it done. But in typical fashion, it'll be in the 11th hour. But up to that event, there's going to be some fear. What if our debt gets downgraded again, like happened back then? You know, that's going to cause the markets to have a lot of volatility. So they'll get it done ultimately. But how much damage is going to be done between now and by the time they come up with that agreement?
So you said, I just don't see any way around it. You know, we told our clients that we expect new lows by June.
Yeah, look, I mean, again, when you look at how big this is, in our opinion, we've told clients this at the end of 2021. This is the largest bubble of our lifetime. It really is. And we've never seen interest rates spike as fast as they've done in a short period of time. the cost of capital for corporate America is 2 and 3 times. And if you're of low credit quality, it could be 4 times. I mean, we just had to have the government backstop banks' deposits because they just went under. So that is usually not the sign of the end of the cycle. That's what happens towards the last phase of a bear market, when you start to see bankruptcies, issues with financial institutions, and then you got commercial real estate. I could sit here and talk to you for 20 minutes on the problems that we're going to have there with the amount of debt that needs to get refinanced. So I hate saying negative things, but that's what the data is saying, and we are going to react to that data.
What about something that is of less value now? I know it's run up some, and I'm thinking about tech. Okay, so I know tech has run up some, but it's less, and when you look at PE ratios, than it has been in the past still. Something like that, or no?
So look, I think at this point in time, the best thing for an investor to do when you have all these dynamics that I just shared with you going into a very tough quarter, I think the best thing to do is just kind of sit back and see what happens. I'd rather be late than early to the next bull run, because if you're early and you jump in today thinking you're getting good valuations, you could see a market drop by 20% from here. Because I think we could see 3,200 very easily on the S&P. So tech there's some great quality companies there, and I think that's why you've seen that kind of, I'll call it flight to safety. But at the end of the day, no one's immune to a recession or some type of credit crisis.
Understood. Eddie Ghabour, it's great to see you. Thank you for all of this, owner of Key Advisors. Thanks, Eddie.
Thank you. Have a good day.